is the Day of National Reconciliation. It's a day that marks the end of apartheid and celebrates that. And the purpose of today, the 16th of December, is to foster unity and reconciliation across the country here in South Africa, but also it's been taken up by people around the world. So I'm so happy to be speaking to you on a day like this. We need a lot of reconciliation and a lot of unity in our world. So I just wanted to welcome you to this webinar. It's the second in a series of conversations hosted by IDRC in collaboration with our knowledge partners from Southern Voice and from the Institute of Development Studies in the UK. The webinar will be an opportunity to discuss an emerging issue in the COVID context, public debt. It's likely to have a growing impact on the policies of many lower income countries, as I'm sure you know. We trust that this will be of interest to you and that the discussion will be rich, and it will be of interest especially to the research institutions from the Global South that are building the evidence for policy responses that are so needed, and also for colleagues from international organizations, from Global Affairs Canada, from the UN Department on the Economic and Social Affairs, from the IMF and others. So welcome to you all. So we'll start the webinar with two scene-setting presentations, one by Shakira Mustafa and the other by Stephanie Griffith-Jones. This will be followed by three brief comments by Dr. Ndugu and Dr. Shipalana, and then Dr. Kasiri. This will be followed by a discussion, and hopefully we'll have a lot of time for lots of rich discussion, and that discussion will be facilitated by my colleague Ariane Dehaan. So we start the presentation with Shakira, and she'll be focusing on the growing public debt in lower income countries, looking at its composition and its associated risks. So Shakira specializes in public administration and development finance at the Overseas Development Institute in London, one of the organizations that IDRC has the privilege to work with on the response to COVID. So Shakira, the floor is yours.
Good morning, good afternoon all. I'm delighted to be participating in today's event and joining such a distinguished group of speakers. So bear with me while I try to share my slides, which hopefully should go seamlessly. Does everyone see it?
Yes.
Perfect. So today I'll be starting off by looking at public debt in lower income countries, particularly the overarching trends and the challenges ahead. Just to give you a very brief outline, I want to cover five areas in my presentation today. First, the trends in lower income countries, which is roughly about 76 countries, which, as you can imagine, is a very diverse group of countries. So where possible, I may focus in some smaller subgroups, particularly lower income developing countries, which is about 59 countries, and it excludes high income small island states and recent graduates from IMF concessional financing facilities, as well as sub-Saharan Africa countries. The second point I would like to look at is the increasing debt service burden, that is the payments that borrowers are making to creditors in the form of interest and principal repayments. Thirdly, the changing composition of external debt in terms of who are the creditors and how has that changed over the last 10 years. Fourthly, the growing debt risk and vulnerabilities. And finally, what is probably my favorite topic actually is taking a step back from the numbers and looking at how have systems and processes related to debt management changed. What are the gaps and weaknesses that remain to be developed? So this graph shows public debt ratios as a percentage of GDP between 2008 and 2021. Of course, the last 2 years are projections from the IMF. And what is very clear from this graph is that from 2011 to about 2017, public debt ratios have increased persistently. And even before the pandemic hit, it was at very high levels. There was some stabilization among low-income countries in 2017, 2019, but in a majority of cases, like 60% of the countries, debt ratios continued to increase, though at a slower rate. And of course, with the pandemic, debt ratios have increased significantly. The next slide, we look particularly at public debt ratios as a percentage of GDP in sub-Saharan Africa countries. Again, this shows from 2000 to 2021. The last two bars, the lighter blue, shows the projections for 2020 and 2021. From the shape of this graph, which I'm sure, which Stephanie will also be speaking about, because of debt relief, public debt declined significantly in sub-Saharan Africa until the end of 2000s. But because of this clean slate and ambitious development objectives, countries took advantage of the fiscal space to borrow more. And as a result, public debt increased rapidly from about 35% of GDP in the early 2010s to about 55% of GDP in the mid-2010s. It broadly stabilized thereafter, and actually before COVID, we were expecting that it would start declining in 2020 as several countries were planning fiscal consolidation. However, the pandemic hit and sub-Saharan African countries had to respond, relaxing their fiscal stance. And as a result, public debt is projected to increase to about 65% of GDP by the end of 2020. So what's more worrying than the high debt levels before the pandemic and with the pandemic now is the fact that the debt service, the cost of borrowing, the payments have increased. This graph shows the average interest burden as a share of revenue for 2013 to 2019. The yellow bar shows the average for lower income economies, while the other colors represent particular regions. On average, for lower income economies, between 2013 and 2019, this interest to revenue ratio rose from about 6.3% to 8.7% in 2019. Moreover, when you compare the regions, you see how from 2017, sub-Saharan Africa interest burden surpasses all the other regions. So what about the countries that received debt relief? According to the IMF estimates, the interest to revenue ratio on external debt has risen in half of the countries that benefited from HIPC debt relief above the point when they got full debt relief. So we're nearing that problem area again, where debt service is getting too burdensome. And as a result, because more of your tax revenue is going to repaying debt service, that means less resources, less fiscal space for spending on health, education, and other critical areas. So these are projections for 2020 and 2021. And again, this comes from the IMF, and it shows that when you look at the first three bars, they're declining. And it shows that the share of lower income developing countries whose debt service was supposed to be less than 20% of tax revenues will decline in 2020 and in 2021. In fact, according to the IMF, it will exceed 20% in over half of the lower income developing countries in 2021. So what's behind this growing debt service burden? And what's really important is to look at the structure of debt, particularly external public debt. And what's very clear from the data collected by the World Bank is that concessional financing is accounting for a smaller proportion of external debt as countries are shifting towards more expensive sources of financing, particularly from the private sector, aka commercial banks, bondholders, etc. So this figure shows that on average, concessional debt is falling as a share of total external debt between 2008 and 2019. And this is true for lower income economies, for low income developing countries, and for the sub-Saharan African region. And as I said, this is largely driven by the increase in commercial debt. This graph shows the breakdown of debt in terms of creditors. The blue represents multilateral, so the World Bank, the Asian Development Bank. The red is the traditional bilateral creditors like the France, the UK. The white bars with little specks represent non-Paris Club creditors like China, and the green are the commercial creditors. And as you can see, while the traditional sources of financing have been a bit flat relative to GDP, it's really commercial bank creditors that are driving the increase in public debt we've seen recently, and to a lesser extent, non-Paris Club lenders. At this point, I want to emphasize that diversifying financing sources is a good thing. Achieving access to international capital markets, it's an important sign of development, a sign of progress. And that's why many countries want to protect that access. Bond issuance, particularly, have grown continuously since 2016. about 2 percentage points of GDP per annum. At the same time, participation is still concentrated. Among the lower income economies, only 22 have issued international bonds. And out of these 22, 10 of them are responsible for 85 of the issuances between 2017 and 2019. So, of course, I have to talk about China. China has been in the headlines a lot because of its approach to debt restructuring, the lack of transparency of its lending, and recent studies showing that how China is reducing its overseas lending since 2016. So using the data from the World Bank, what is obvious is China is an important bilateral lender to lower income economies. This graph shows particularly the share of bilateral debt that is accounted for by China. The blue bars, the red is Japan, the green is India, purple the other G20 creditors, and the lighter blue is other non-G20 bilateral creditors. So what's clear is that China has increased its share of this bilateral debt from on average 31% of debt in 2013 to 40% in 2016 and 2019. However, if you include China as well as the other G20 countries, you see that how majority of this debt is owed to G20 countries. So I mean the last bar in 2019 is about 20%. So that means 80% is to G20 countries. That's why G20 initiatives like the debt suspension service initiative is an important development. However, I mean, as I said, diversification of financing sources is a good thing, and but it has also exposed countries to new risks to debt sustainability, new risks that in some cases aren't being properly dealt with or monitored. So a few risks just worth mentioning: refinancing risk and exchange rate risk. Refinancing risk is the risk that debt that you will roll over. You can't do it either because it's too expensive, or in some cases there isn't a market to roll over that debt. This is usually a concern for countries with volatile or rapidly deteriorating economic fundamentals, with some sort of political risk or experiencing some sort of financial distress. The second risk is exchange rate risk. And this is usually associated with volatility in exchange rates and the impact this will have on interest and exchange rate costs for debt that's in foreign currency. For many countries, it is one of the principal risks in a government's debt portfolio. But at the same time, these are risks, and risks can be managed proactively. And there are several countries that are taking concrete steps to better manage these currency and rollover risk. For example, Ghana, Senegal, they've engaged in debt buybacks to ease refinancing risk and to reprofile external debt. So basically, they're trying to spread the maturity, etc. So my last slide relates to debt management capacity in lower income economies. To really effectively manage these risks, it's important that countries have the structures, the institutions, the processes in place for effective debt management. And several lower income economies have made progress in specific areas of debt management. For example, they've been developing and publishing debt management strategies. They've been producing debt reports, but significant gaps remain in very critical areas. So this slide, it shows the results of a diagnostic framework designed by the World Bank and the IMF. It's called the DEMPA, Debt Management Performance Assessment Tool. And it assesses the capacity of a country's debt management along 14 dimensions. So this figure basically shows the percentage of countries that meet the minimum score in this assessment tool. So the further away you are from the center of the spider web, the better, because that means more countries are meeting the minimum score needed. So the green line represents frontier market economies, so economies that have access to international capital markets, while the blue are the lower income economies. So what's clear in this first is that the frontier economies seem to be doing better along most dimensions. But at the same time, I think it's important to emphasize and recognize that most countries do not meet the minimum debt management standards as identified by the World Bank and IMF. At most, half implement satisfactorily any of the 14 debt management dimensions assessed. And for the frontier market economies, between 30 to 40% are assessed as not meeting all the minimum requirements across the performance indicators. Ultimately, considerably more needs to be done to strengthen debt management's capacity so that countries are better able to manage the complexity and volatility of debt flows, particularly in frontier economies that have tapped international debt markets. That's it for now. But looking forward to the questions later.
Thank you so much. Thank you so much, Kira. That's an important overview of the trend and the changing nature of that, the positives and the challenges in there, and definitely also the last point. And I'm sure that other speakers will also touch on that. I think, particularly Professor Ndungu on the capacity to manage that. So thank you so much for that, setting this scene for us. We'll quickly continue with, and it's a great pleasure and honor to introduce somebody I don't need to introduce because everybody in this field will know, Professor Stephanie Griffith-Jones, who has a very distinguished career working on global finance and the need for reform. Very nice to see you, having you worked with IDRC as well some 20 years ago. So many people are so happy to see you again at such an important time, of course. And she will today, as gracefully agreed, to talk about an initiative, a report that she has launched, which looked at debt relief, particularly for a green and inclusive recovery. So Stephanie, thank you so much again, and the floor is yours.
Well, thank you very much. I'm delighted to be joining this meeting and honored to be here with the other speakers. I'm about to start sharing my slide. Thank you very much for the kind introduction. Oh, I successfully shared my... Can everybody see the slides?
We can see it, thank you.
Okay, great. I first wanted to say thank you very much for the nice introduction, Arjana, and I really congratulate IDRC for this very important initiatives that it's taking with colleagues, particularly from the South. And as Arjan mentioned, I had worked in the past with IDRC, and they're the best donors I've ever worked with, funders that I've ever worked with. And I'm not just saying it to you, but I've said it to many other people. So I'm really pleased to be here. My main brief will be to talk about this initiative this report that we launched. But before I start that, I would just like to say that debt relief is one of many initiatives that I think are necessary at the international level to deal with this COVID crisis that has hit the developing world and particularly low-income countries so badly. And I would just like to highlight another area where I've been doing a lot of work and where we recently had a summit, which is the role of development banks, both nationally, but I want to particularly stress multilateral and regional development banks. Because among the areas where I think there is most potential for policy expansion, policy response at the international level and the regional level is to increase the role of multilateral and regional development banks. Because I think that's probably one of the most promising avenues. If their capital, for example, can be increased, or the paid-in capital of the African Development Bank could be dispersed more quickly. Now it's going to be dispersed in 10 years. Then it would have more headroom to do more financing. And so in general, I think development banks can play a particularly big role because they're very counter-cyclical, but they need to have the resources to be able to do that. So this was a side comment. Of course, there are other important international measures like issuing of SDRs. There is a proposal on the table that hopefully a new US administration will treat much more sympathetically than the previous one, which would also be very valuable for low-income countries. But I mean, now I will focus on debt relief and thank Shakira for her very nice introduction with the data. This is based on a report, a joint report that we did with Uli Walsh, Shamshad Akhtar, Kevin Gallagher, and York Haas. We have three principles in it. The first one is that we need a real debt relief, not just suspension, which is what is being granted by the G20. We think we need involvement of all public creditors as well as private creditors. And we think a third element is that governments which would receive this significant debt relief need to commit to align their policies and their budgets, both with the 2030 agenda on sustainable development and, of course, specifically with the Paris Agreement on climate change. And I think the emphasis is also on scale, because we have the history, both in Latin America and in Africa, of debt relief being done too little, too late, and tremendous development costs. And now it would be not just massive development costs, but also costs to the climate. And of course, we know that the planet cannot wait. So there is a particular sense of urgency and the need to move forward quickly, which is perhaps not so clear in the minds of the creditors as it should be. Although it's very encouraging, people like Carmen Reinhardt, now chief economist at the World Bank, is actually pushing very strongly the same line. So our proposal has three pillars. The first two pillars are for countries that are heavily indebted with an unsustainable debt burden, and I'll go into more detail a little bit later. And the third one is for countries that are not heavily indebted, but that would still benefit from having debt relief at a more specific level channeled towards green and inclusive recovery. So you may know that the G20 recently, in their last meeting, agreed on a common framework going beyond the debt suspension. And so we welcome this, but we feel it needs to be enhanced. The first, because it has three key shortcomings. The first one maybe is not of so much interest in this discussion, but I think it is still important that it applies only to low-income countries and omits middle-income countries with unsustainable debt. And of course, if you look at it from an African perspective, actually a lot of the countries now are middle-income countries. And so to just exclude them explicitly just because they've done well seems a bit of a strange thing. And it's also important to stress that 8 out of 10 people of people who are in poverty are in middle-income countries. So if you leave all middle-income countries out, you're leaving a large chunk of poor people out as well. It's very weak, this common framework on private sector participation, and fails to address the first mover problem at the level of the debtor countries. And it is not really geared to linking to climate change and greening the economy. So as Shakira showed, public debt was already unsustainable before COVID, but now with low growth scenario or negative growth and
Stephanie, we just lost you. It seems that you muted yourself. Is that right, Emma?
Indeed. It does look like your feed is muted.
You can't control that. I'm sorry, everybody.
I can't, unfortunately.
sorry, can you hear me now?
We can hear you now.
Sorry, I have to.
Yeah.
I think I now have to go back into the PowerPoint.
Yes, we can hear you now, but not see the slide.
Yeah. Can you see the slide?
Yes, we can again. Thank you.
Yeah, I apologize.
No worries.
So when did you lose me? I mean, I was saying that public debt was already unsustainable, as Shakira had shown.
Yeah.
But that now it's getting much worse.
Please
And then the key point from the point of view of countries is that the countries is that the settlement, the servicing of the debt, of course, reduces fiscal space and constrains the ability of governments to respond to the health, to the social, to the economic, and to the climate crisis caused by the pandemic. And so if not addressed, the debt crisis will hold back the recovery and undermine development crucial for so many people in the global south. I have here a graph that is similar to ones that Shakira showed about how sub-Saharan African countries' debt service as a percentage of exports of goods and services have started to increase since about 2011, 2012, and of course will shoot up in the wake of the pandemic. And this is quite an interesting graph because it shows the lower line is GDP weighted and the upper line is just adding the countries, is how sharply sub-Saharan African ratings have fallen. Before the pandemic, they had improved a lot, but they are now falling. So, and an interesting fact is that no sub-Saharan African country, except recently in the last few weeks, Ivory Coast, has had access to the private capital markets since the pandemic started. And I think that's an important case because in the discussion, a lot of policymakers are concerned about losing access to capital markets, but at the moment they don't have it. And this is a sharp difference from, for example, Latin America, where countries have returned to the markets quite significantly and at relatively low cost. So this is an option which I think is not available at the moment, and therefore the need for debt relief in a way. If you have less money coming in, you need to be able to service less outflows so that you have some money left and some foreign exchange left for doing imports and growth. So as I said, we need urgent climate action. This is our last chance this decade to avoid catastrophic global warming. And this is also important for sub-Saharan African countries because many of them are particularly vulnerable. They're not the ones who caused it most, but they may be the ones who may be affected most. And therefore it's important that these countries, as well as the rest of the world, are able to invest in both mitigation and adaptation to improve resilience. And also there is a bit of an opportunity because there is this economic stimulus and recovery measures linked to COVID, but they should be used also to strengthen the resilience of the economies and engineer a just transition. One of the important things to stress is that climate change actually raises the cost of capital of climate vulnerable countries and therefore threatens future debt sustainability. So you have a sort of vicious circle because if your cost of capital increases because you're climate vulnerable, you will have higher debt servicing in the future. And therefore governments must climate-proof their economies and public finance or potentially face this ever worsening spiral of climate vulnerability and unsustainable debt burdens. And what is interesting is that there has been a lot of papers recently showing that green projects generate more employment and deliver higher short-term returns per dollar spent in terms of growth compared to conventional fiscal stimulus. And the recent IMF WEO highlighted that the green recovery, therefore, is not only environmentally sensible, but also good economic policy to lay the foundation for longer-term economic success. So you have what economists like to call win-win situation. And on the other hand, countries that are deep in debt will be unable to invest in a green and inclusive recovery. So the public debt problems have to be urgently addressed in those countries that are debt constrained so that they can finance the crucial health, social spending, and green recovery. And we need a framework that provides debt relief to countries that require it, while assuring that this relief is channeled towards protecting the vulnerable, attacking the virus, and having an inclusive and green economy. So a first step seems to be to have a comprehensive debt sustainability assessment for all leaks and mix with public debt problems. I mean, the conventional thing is that it's carried out by the IMF and the World Bank, but we feel there should be inputs from other institutions, particularly those also looking at climate risks and their effects on debt sustainability. And then if this debt sustainability analysis shows that the public debt of a country is of significant concern, the ideal way forward would be for the G20 to coordinate with all bilateral and multilateral creditors about debt restructuring. So we, as I mentioned at the beginning, we think about 3 pillars. The first one is for heavily indebted countries, getting debt relief from public creditors. And we argue that there should be comprehensive and significant debt relief granted to heavily indebted countries with an unsustainable debt burden, analogous but improving upon the HIPIC MDRI model. And governments receiving debt relief would commit to align their policies and budgets with the 2030 Agenda and the Paris Agreement. And in the case of multilateral institutions whose capital is so valuable to the whole world community, including the low-income countries themselves, that debt would be only restructured for IDA-eligible countries. And to safeguard the preferred creditor status of multilateral institutions, the losses made would have to be financed by bilateral contributions, for example, gold sales or SDRs, as indeed was done in the case of HIPIC. The second pillar, which we think is very important, given the increased significance of the credit from the debt owed to private creditors, which Shakira again showed very clearly, and the high cost that this debt has, is to involve the private sector. The HIPIC initiative and also the Brady plan shows clearly that compulsory participation will be necessary, not only from the official creditors, but the private sector alike. If a debt sustainability analysis reveals problems, the IMF should make its programs conditional on a sovereign debt restructuring involving private creditors. And debtor countries seeking bilateral haircuts should seek commensurate relief from private creditors. But I think it's very important to stress that we can't just leave the debtor country alone facing these very powerful private creditors, and that we should help them. And so one idea that we have, and that I think needs more study, is that the private creditors should be participating in the debt restructuring, would need some incentive, some encouragement or pushing to do it, as was done, for example, in the 80s, but also some additional incentive, like, for example, and mimicking here a little bit what was done under the Brady plan in the 80s, to swap their old debt holdings with a haircut for green recovery bonds. And so they would take a loss, but they would get a better paper with guarantees. And then this reduced debt service burden from the debt relief could be also used by debtor governments, like in the first pillar, for spending on a green and inclusive recovery. And so, as I said, the debt issued by the countries would have some kind of credit enhancement. In the case of Brady, it was US Treasury bills, because it was mainly a Latin American problem and mainly American banks that were involved. Now it's a more global problem, so it would have to be some kind of credit enhancement, for example, secured by an issuance of bonds by a AAA rated multilateral institution, the World Bank or the regional development banks, or some way use SDRs issued by the IMF. And then this would help countries because it would make creditors willing to accept significant haircuts, and also it would make it acceptable for countries then to more likely to regain access to international capital markets. In the case of the Brady Plan, it was very successful. In fact, almost too successful, because a couple of years after the Brady Plan, Latin America returned to the capital markets, which was very good, but then it had another crisis because they borrowed again too much. But that's not the problem today. We need to get countries to have debt reduction and then to return to access to the private capital markets. Then we can discuss that they shouldn't borrow too much. And there's a third pillar for countries that don't have an immediate problem of having too much debt, but that also need to channel more funds to green and inclusive recovery. And here we think that the mechanism of debt swaps could facilitate raising climate ambition in the form of additional action in climate adaptation and mitigation. This would be voluntary and not conducted as a distressed debt exchange. And it could be again complemented, but not necessarily, by an incentive scheme for the issuance of new sustainability-linked sovereign debt. And we have experience. I've personally been involved in some of these debt swaps. And one of the most important lessons, I think, is that you need to have it done on a significant scale to make it worth all the transaction costs involved. And you need to have good monitoring that the money is channeled to the good causes. And there is some very good experience on this, which could be built on. This should be linked, of course, to align policies again and budgets to the 2030 agenda and Paris. And this could be monitored by some kind of intra-institutional steering committee. And there's a UN ECLAC proposal for the Caribbean. There's an emerging UN ESCWA proposal that I've a little bit been involved with, which also proposes a role for the UN to have some kind of steering committee. Obviously, we'd have to involve the IMF, the World Bank, but also, I think, local institutions, civil society, and so on. With this, I finish. There is here a link to the full report. And I thank you very much for your attention. But I would like just to emphasize again that the scale of the debt relief would have to be significant, that part of the debt relief should be channeled to this green and just recovery. So the additional fiscal space would partly go to the areas that the governments think have the highest priority, but also part would have to be linked to the international priorities. And also, I think that we advocate the hope that this should be a comprehensive package, that it should be for public and private creditors, that it should be for middle income and low income countries as well. Thank you very much.
Thank you so much, Stephanie. Indeed, a round of applause. Thank you so much. Your points about the urgency, the need for comprehensiveness here, your indication of the various measures that need to be put in place. And I don't know there's people in the audience who are very interested in particularly bringing to scale past measures of instruments of debt relief, debt for climate swaps and so on. So we will for sure come back to that. Thank you also for highlighting how those assessments need to be made, the different actors that should ideally be involved in this, and I think there's no better speaker to pick up from that than our next speaker, who also doesn't need an introduction in this in this group of this webinar. But it is a great honor and pleasure for me to introduce the next speaker, Professor Nguna Ndungu, who has a career in the practices of national finance, of course, and currently is the executive director of ARC, the African Economic Resource Consortium. And there's no institute, I think, in Africa that does more of the capacity building work, the analysis on those issues. And currently, ARC also very privileged to work with ARC on one of the research projects in response to COVID. So, Professor Ndungu, the floor is yours.
Thank you very much, Arjen, and I'm very happy to be here. Just like Stephanie, I was also a member of IDRC, and I left IDRC to work for ARC, which was founded by IDRC. So you can see I'm still in the same family. Then I went away and went to policy making, then I'm back to ARC after 12 years of absence. So you can see we are in the same kind of boat here. I'm very happy that you made some very interesting propositions, and Shakira as well. And I'm very happy about the way things are coming out, because this is a very important discussions. And I think let me start by saying that because I have very little time to make comments, let me actually start by saying that given the time I have, I can actually start by actually talking about what is happening, what is the correction we can make for many sub-Saharan African countries. And one of the important aspects of that is that the HIPIC was successful for most of them. Remember, when the HIPIC started, ARC, that was 1997, ARC was invited to actually make a presentation in terms of the analytical side of it. And we argued that the debt itself was actually inhibiting growth in Africa, both starting from investment and then affecting growth itself. And we argued that because of creating that uncertainty, the debt then was actually creating an uncertainty that pushed the market to acquire an option, a waiting option. And so in ARC, we argued that we needed an external mechanism to disrobe the market from the waiting option. That's how the HIPIC initiative came about. We are very happy to be associated with that. But now, so many years down the line, we have seen that things are coming back. For example, if I talk about what has happened, if you see that the debt to GDP ratio came down from as high as 85.3% in 2001 to 34.3% in 2011, but now we have seen some African countries are now reversing this trend, but they are reversing this trend amid so many other problems that are coming up. For example, out of that 6 poverty reduction and growth trust countries that are eligible, sub-Saharan African countries that are eligible for PRGT in sub-Saharan African countries, the debt sustainability conducted between 2008 and 2018 were actually classified as either in debt distress or high-risk debt distress in 2018. And that is for us a very, very interesting finding, because essentially why are countries reversing back to high-risk debt? Of course, the world then was hit by COVID. We are talking about the period before the COVID, and now we have the COVID. The biggest problem with the COVID-19, this pandemic, is that it requires huge public sector expenditure outlay. But then they are dwindling revenues, and some of the countries started with a very diminished fiscal space even before the COVID struck. So essentially, what we are seeing is that it is actually threatening public debt outlook and even macroeconomic stability. And this is very, very important even for IDRC to bring this discussion, because we need to organize the discussion with various centers, especially in terms of looking for solutions, how low-income countries can handle the growing debt levels amidst the pandemic that we are experiencing right now. The ARC considers the focus areas very critical, and I would like to leverage on distinguished pool of network members at the ARC who also consider who are also very strategically placed in terms of contributing to the debate, but also contributing to the policy discourse. And the ARC has recently come up with different initiatives. For example, I can tell you that in this December, we organized a biannual plenary focusing on opportunities and challenges for the COVID-19. And one of them is with relation to public finance. And it is clear that those deliberations showed that government capacity to mobilize revenue largely depends on the structure of the economy and also related to institutional arrangements. And we have argued that we may have to look at the future in terms of domestic resource mobilization, but more importantly also the instruments required, the tax instruments required. And now that the digital platforms are working very well, payments, electronic payments platform, we need to look at a combination of tax instruments and electronic payments platforms that are going to be suitable, so that we can actually look at reforms in that side that is going to be quick and very important. And obviously it may help in terms of bringing back the fiscal space, which actually has been dwindled. The second one is that we started from 2019 June, we focused on growing with debt in African economies. We started earlier with a brainstorming session in 2018 December, and that time, because we wanted to invite policymakers, we had a title on the looming debt crisis in Africa. And because we had invited several ministers of finance to talk about it, they came in defense in terms of what was happening. But I think what we realized is that since we had very good experts in this area, in June 2019, we commissioned papers and we wanted to come up with a theme of growing with debt in African economies. And you do remember, I think Stephanie mentioned Carmen Reinhardt. They have a paper, I think, coming back way back in 1997 or thereabout, it was growing with debt. And this is a rag literature, and we know that they are going to be a very important finding. The most important thing in terms of the findings from these papers is that first, we think that we are focusing on the wrong debt sustainability analysis, because they have projected higher debt carrying capacities, and that has led to a faster pace of debt accumulation. And we may want to relook at it, and some of the papers are focused on that. And second, countries have paid more attention to debt ratios instead of the speed at which these ratios change. And again, you could see that what Shakira and Stephen presented, you can see the declining ratios, but that is not what was projected. The third point here is that the debt has not been fully used to fuel capital accumulation and income convergence through public investments. What we have seen is that we have not seen, for example, they are not closing the infrastructure gap. So they are risking debt spiral in the future, and they are also robbing the economies for capacity for future growth, because we did not achieve the public investment we anticipated. We did not achieve the income convergence that we anticipated. So in a sense, we are running the risk of debt spiral, and also the future capacity for growth in economies is actually going to be compromised. Those are broad papers, and I do believe that they suggest that we may have to come up with what we may call transparency in terms of debt accounting. We need greater realism in terms of growth forecast, and we need diligence in terms of matching what their seemingly limitless public investment needs with weak public sector capacity to manage the infrastructure investment. There's been, in fact, the political economy in this factor says that why African countries have moved perhaps to private debt is because they don't want this scrutiny of how they deliver the public investment. But it's a discussion we can do that later. The second scope of issues that we have dealt with is the low-income countries and how they deal with debt challenges, and what can be achieved by leveraging developed countries and multilaterals. And these entities can expand their role of providing short-term liquidity with the suspension of debt service. And this is again along the lines that Stephanie presented. But the biggest problem with the provisions for debt relief and what we have seen, the history of the HEBIC initiative and how we are coming back, I think there are a series of, should I say, commitment issues or commitment ways. But debt relief should be bound by reforms, and then we should come up with the kind of reforms that require. And two instruments are particularly important here, and one of them is guidelines for responsible lending and borrowing and effective debt management strategies. Since I had very little time, I can only say that first, we have dealt with so many issues on COVID, and because we wanted to deal with those issues, because we wanted to show that actually what has happened, the COVID pandemic, the fiscal space, and even the lockdown in some of the countries, at the time when they were also fragile, we started with fragility of growth in some of these economies. That fragility was not actually only restricted to countries that were coming from conflict or are in conflict. We realized that fragile contexts were also coming up from countries with a very narrow range of economic activities. So the collapse of commodity trades was actually leading them to fragility. And what we have realized that we quickly mounted some studies on the impact of COVID on poverty and inequality in Africa. And in 5 countries, Ghana, Kenya, Ethiopia, Senegal, and Uganda, we found that actually what we have achieved in terms of poverty reduction in the last 20 years has been wiped out, and even inequality. Right. And so we are seeing that is very, very critical. It's something that we may want to look at when we look at macroeconomic impacts of COVID and social cohesion in Africa and similar papers that we are coming up. We have several initiatives that are working. But the most important thing for me is that we really need such discussions that IDRC has really provided for us here. We need actually policies, for example, that will talk about how do we diversify these economies? How do we lead to economic transformation in the future after the COVID is solved, and what can bring quick economic recovery? And closer home, when we come to sub-Saharan African countries, this diversification and economic transformation will be difficult without actually pushing the success of continental free trade area and the reforms in the global value chain restructuring, and that is very, very important kind of contributions we have made in the T20. So these are very important aspects, and for me, I do believe that we'll get some headway in terms of combining so many of these aspects, not only from debt relief, but macro stability and how we can actually form very, very strong features for future growth. And should I say visions for growth, visions that provide us with policy clarity, and that's going to be fantastic. Thank you very much, and sorry for taking more time than I was allocated.
Thank you so much. No, I think I should apologize because the richness of what you have to bring, we're clearly not able to do enough justice to this in the time that we have. There's many of those issues we will come back. I think what you're highlighting is very much a future research agenda, capacity agenda. Thank you for highlighting, I think, underlining the points that the previous speakers made, both on how debt relates to growth and relates to poverty reduction, which of course what a lot of the work in the 1990s that you contribute to was about, and also the institutions, as I think Stephanie was highlighting, the institutions that need to contribute to that debate on the civil society side, on the business side. So many topics we will come back to, and I'm sorry we have so little time for this at this point of time. Our next speaker, and I think this will pick very nicely up from all the previous speakers. Our next speaker is Palesa Sipalana, who's at the South African Institute of International Affairs, where she leads the economic diplomacy program, and recently co-authored a paper on the damages in global equity and debt markets. So Palesa, thanks very much for joining us. Also, you have 5 minutes in case people wondered. The bell that we ring is not for Christmas. That's to help the speakers keep to time. And I'm sorry for doing that so drastically. Thanks so much, Palesa.
Okay. Thank you for this opportunity, and welcome everyone. I want to touch on green fiscal reform as one of the financing instruments that LICs or developing countries in general can rely on, given that they are now severely constrained in the fiscal side, and in terms of monetary policy, there's little room to maneuver as well. Green fiscal policies are a critical part of the efforts around the world to transition to an inclusive green economy. And why are they important is because they reflect externalities in prices. And then they also help governments to align their expenditures with their own environmental goals. And they're also useful for raising much needed revenue in LICs. And also they also create the fiscal space for green investments, which is what we are hoping every country will move towards. And also they also are helpful in creating a broader fiscal reform that will help to support the implementation of the SDGs in developing countries. In the short term, the obvious benefits of green fiscal reforms is, for example, carbon taxation or or fuel subsidy reforms. They help to generate and reallocate significant resources that are needed for COVID-19 relief or COVID-19 stimulus packages, and they will also help with recovery measures, while also green budgeting in itself can offer medium to long-term benefits by rationalizing and aligning the budgetary processes in each domestic economy with government objectives for sustainability, as well as a resilient post-COVID-19 economic recovery. Just to give an example of the most recent achievements by Egypt, it signed up for the World Bank's Energy Sector Management Assistance Program, which helped it to bring down the fiscal cost of subsidies significantly, actually around 50%, to an average electricity tariff closer to the cost recovery of electricity in that economy. And also due to a combination of high existing fiscal deficits in LICs, as well as the risk of inflationary pressures right now, both the borrowing capacity and the monetary policy space, as I mentioned earlier, is severely constrained in both developing countries and low-income countries. So it's a case for green fiscal reform in these economies. And lastly, on this point, I want to also mention that although green fiscal reform has failed to take off due to obstacles such as special interest groupings that are lobbying against them, lack of political will in domestic economies, limited transparency and awareness of these instruments, there is significant benefit, but each economy needs to assess the efficiency and distributional impact of this instrument before it can go ahead with implementation. Just to contribute to the calls for debt relief, I'd also like to mention that there's been a strong Southern voice on this debate. You might have seen that the AU, the African Union, through their chairperson, the President of South Africa, Mr. Cyril Ramaphosa, has also been urging countries around the world to lift sanctions against Zimbabwe and Sudan in Africa, to allow them an opportunity to better combat the coronavirus. Because I mean, the continued onslaught of these sanctions basically mean that these countries are impeded from responding adequately to the pandemic and save lives in their own country. The AU has also called for the suspension of interest payments on Africa's both external and public debt. And in effect, they are seeking for a 44 billion debt relief. And also included in that amount is the suspension of interest repayments, as well as a stimulus package of 100 to 150 billion. And as all the and in conclusion, I'd like to also mention that as all the speakers have been talking about the G20 that have been agreeing to deferrals and cancellation of interest payments, they are also, the G20 itself is less willing to accede to debt cancellation at this point. And the absence of significant assistance from the international community to Africa will impede our ability to recover economically, and also to fight the pandemic from the health sector side. I think I'll close there. Thank you so much.
Thank you so much, Palesa. And again, I apologize for the short time given. Thank you for this emphasis on the green fiscal reform, the measures, the capacity, also, and also to highlight the political will, which of course will be a very important determinant of its success. So thank you so much for that. Our last speaker, and then we'll move to discussion after that. In the meantime, if people want to start putting questions in the chat box, please feel free to do that. Otherwise, we'll come to the discussion. Raise your hands after that, but not before our last speaker, Ibrahim Kasirye, who's at the Economic Policy Research Center in Uganda, one of those institutions on the African continent in Uganda, who's provided so much input to those debates in the past. So it's a great. We're very happy, Ibrahim, that you can join us today to inform those priorities for the future. And of course, EPRC, we're also privileged to be working with EPRC at this point of time on one of the research projects with focus on small and medium enterprises, but also with a broader fiscal macroeconomic lens. So thank you, Ibrahim. The floor is yours also for 5 minutes.
Thank you very much. Good morning and good afternoon, wherever you are. My presentation or response will focus more on what was presented by Shakira. And unlike other colleagues, I will use more of a one-country case study. And as you'd guess, it will be Uganda, and provide some kind of retrospect and prospect for Uganda's debt in the face of the COVID-19 pandemic. Just to set the stage, to note that even before the COVID-19, the debt levels in developing countries like Uganda were at relatively approaching unmanageable levels, especially during the past 10 years. And I think the past 10 years have witnessed the largest growth in public debt if you compare over the last 50 years. Specific for Uganda, the level of public debt increased by around 30 percentage points between 2010 and 2020. Worth noting, China accounts for the largest increase in the bulk of the increase in Uganda's public debt. As also, even as we expect to borrow less to finance infrastructure, but to deal with the pandemic, this debt is likely to increase quite substantially. One of the issues mentioned by Shakira was what's driving the increase in the trends in the increase in public debt. In Uganda, one of the key drivers was the improved prospect that Uganda will become an oil producer very soon. So there were more willing more willing donors than previously. But then there was also the changing development paradigm from the investment in social sector to infrastructure. That also contributed to the kind of structure of the public debt that we've seen. Nonetheless, there's been volatility over the past 1 year due to the widespread financial stress that has emerged due to the COVID-19 pandemic. In Uganda, surprisingly, domestic debt accounts for about 60% of the total debt. And also worth noting that the level of domestic debt has also been increasing at around 20% on annual growth of more than 20%. And this should be a cause of concern, given the previous debt that we've held is not being retired, but more or less being rescheduled or rolled over. The near exponential increase in domestic debt raises concern about Uganda's debt sustainability, more so when the conditions responsible for the increase are mainly for financing the budget deficit, which is still ongoing and has increased over the past 1 year due to COVID. Also, 50% of Uganda's domestic debt is short-term. That is with a maturity of less than 5 years, but nonetheless contracted at interest rates, and these are based in Uganda shillings and not dollars, of more than 10 percentage points, which in other jurisdictions would amount to some form of non-concessionary financing. Specifically, less than 20% of the domestic debt, that is either 10 or 15 years, can be termed as long-term debt. But it's still non-concessionary in this country, given the high interest rates in the region of 15%. and also given the short repayment periods compared to what we see in other countries that borrow from the idea of close to 40 years. So a very short repayment period affects the likelihood or the need to finance the budget deficit. So what does this mean going forward? That the fiscal deficit, especially for a country like Uganda, is likely to be on the increase, especially now that we need to finance not only the infrastructure, also the debt, but also a new demand from the health expenditure, the health demands that have come on board. But also, it also is pushing Uganda further into borrowing from non-concessionary terms. Initially, during the onset of this pandemic, there appeared to be more funding available from non-concessionary, but as we got into the October and November of this year, this kind of funding is also appears to be drying up. We are projected to hit nearly the threshold for debt sustainability within 1 year from now, and projections are that we're going to borrow more over the next 4 to 5 years. So in a nutshell, we've been borrowing quite heavily to finance infrastructure, but we're more likely to be borrowing more to pay off our debts in the next few years. And most importantly, the health demands or the need to deal with the health crisis is going to affect our overall appetite for debt. So in short, as I conclude, Uganda is following other countries. We had not borrowed that much compared to our neighbors in terms of debt accumulation, but we're moving pretty fast compared to our neighbors ever since the onset of the COVID-19 pandemic. Thank you very much.
Ibrahim, thank you so much. Thank you for bringing that that perspective. We're now moving into the questions. Q&A session. People would like to ask a question, please raise your hands. There's already a number of questions put in the text box, in the chat box, and I'll try to moderate that. We have about 20 minutes left, and let me immediately start off with a question or a set of questions that came from Dirk Willem and Scott, and please correct me if I'm not summarizing this correctly. But the first question that comes up is around this complexity of debt, something that Ibrahim just referred to as well, increasing borrowing very differently from the 1980s, 1990s, increasing borrowing from commercial markets, as Shakira said. That's a good thing in itself. That's a sign of development, but also causing new challenges. Both and the question that come up is like, yes, what is that complexity? Maybe say a little bit more about that complexity. And I think it's a question from Scott in terms of international debt relief support efforts. What does that mean in terms of coordination? Maybe there's a question to all the panelists, but maybe Shakira, you want to start us off, and Stephanie, and then Yuguna after that, perhaps.
Sure. So in response to Jake's question of any examples to kind of put side to side with what is happening in Zambia, in the case of Zambia, they've requested bondholders to agree to a suspension of debt service payments, but of course, unfortunately, bondholders rejected the request, and Zambia is currently in default. And one of the problems is that they're saying the private creditors are worried about Chinese debt, and the Chinese creditors are worried about private sector debt. So just to say, I mean, Zambia is one particular case. In recent years, there have been several successful examples of sovereign debt restructuring with the private sector. Right before the pandemic, they had Argentina and Ecuador. But even before that, there was Chad in 2018, Grenada in 2015, Barbados, Mozambique, Ukraine. And for a lot of these countries, what really helped were innovations in the financial architecture with respect to sovereign bonds, and something called collective action clauses, which I'm sure a lot of us are familiar with. And there's a spate of literature on this topic. But basically, that has helped in a way to overcome collective action problems and bring private sector creditors to the table. Of course, the problem is there's a lot of outstanding bonds that don't have these clauses. So you can't really use this tool to facilitate debt restructuring. But there are improvements, but at the same time, there's a lot of room for improvement still. So because of these innovations, generally restructurings have happened more smoothly in these countries that I listed. They've been more preemptive, so it happened before countries actually defaulted, and it's been the duration of the restructuring talks was shorter. So yeah.
Great, thanks. So again, kind of experience or already issues that may be of or will be of importance for future efforts in that. Stephanie, maybe next, and I think Scott's question was almost like, how do we get a Brady plan going in the current context to simplify the question? Well, what kind of coalitions, what kind of groups can you've already said a little bit about it. Can you elaborate a little bit on that? So, Stephanie, you're still muted.
Apologies. First, I wanted to say that the situation is different from the past because the private creditors are different. They're mainly institutions like BlackRock, for example, typical bondholders rather than banks, as was the case in the past, both in Africa and Latin America. Indeed, what Shakira said is true, that there are these collective action clauses which have been helpful, but they're not comprehensive enough, and they have had to be refined. For example, in the case of Argentina, super collective action clauses, and it complicates the restructuring. And more generally, the problem with private flows is that they're extremely pro-cyclical, both in terms of their availability and also in terms of their cost. I mean, the way, for example, even before COVID, the cost of debt for Sub-Saharan Africa shot up. It was very relatively low and very abundant loans, and then suddenly it collapsed. So there is a problem about funding, in particular so-called frontier markets. But more specifically on a parallel for a Brady plan, I think you have to find somebody, some institution that would perhaps provide some kind of comfort to the private creditors so they would accept this haircut. And so perhaps one can think of as I mentioned, the World Bank or perhaps the African Development Bank that would provide some kind of some sweetener, if you like. But also, I think it has to be accompanied by push. I think the creditor countries who sort of complain if the debtor countries don't go to the private creditors and ask for debt relief, need to really lean on their private creditors in their countries to be more flexible. And I think that was very, very much present during the Latin American debt crisis, where the US Treasury and the IMF were continually putting pressure on the banks to, for example, do involuntary lending, as it was called, and then in the end to do these quite big haircuts. And I just want to highlight one institution which I think is really important that people don't talk very much about, but are beginning to, is the rating agencies. Because one of the reasons why African countries don't want to accept debt relief from public, but also from private creditors, is because they're scared that they will be downgraded. They're rightly scared. Now, I would argue that this is bad economics on the side of the rating agencies, because the economic literature, the best economists argue that if you are over indebted and you get debt relief, your likelihood of being able to pay in the medium term increases dramatically if you get sufficient debt relief sufficiently early. So the fact that these rating agencies penalize countries that request debt relief is, I think, methodologically incorrect. And I think this needs further study and I think policy action, because these institutions are not regulated at all. They have a voluntary code of conduct, but I think their methodology needs to be regulated. And it's actually of immediate concern now for countries in the COVID conflict.
Thank you. Thank you so much, Stephanie. I do want to move on to, and Laura Kelly from IID just posted a question, perhaps a couple of minutes on debt swaps. But maybe before I go there, maybe you go now. You can comment on this question of the issue of the complexity of debt, the role of the private sector, based on your experience, what are kind of the priorities to get that innovation in place, to get that coordination moving better, building on the examples that already exist?
Thank you so much, Arian. I think one of the things that I tried to do and was very successful in Kenya was, for example, let's look at what, like, for example, the Ugandan example that was presented. What you really need is public investment to cross the investment, the infrastructure gap. And then we started saying, let's look at the Treasury's development budget and let's construct an infrastructure bond out of that. And then we raise that across. And from 2009, during the global financial crisis, to the time I left the central bank, we were raising those bonds sweetened very enough. One, because they were on local currency, they were actually very good. And secondly, because you are monitoring the projects, they were quite very effective. Now, the whole thing is that because everybody is monitoring how these projects are going, it becomes uncomfortable for some of the policymakers. But it's actually a very efficient way of actually crossing the infrastructure gap. So you run away from that element of having contracted private sector debt, and then you did not deliver the projects. So you are at a loss because you don't have the public investment, the infrastructure you wanted, the growth trajectory from those investments is not there, and you have to repay the debt. So that is one of the things that we actually did. But now, having come from that, and actually the Kenyan government seemed to have, of course, abandoned that, not because they were not bad, I don't know why. But then what do we do now, right now? And I think that's why I like the presentation by Stephanie in terms of how do we sweeten this so that at least we start moving. Actually, it's an incentive to move away from external expensive debt to domestic debt, which can be repaid, because essentially it is an investment. It's an investment to the locals and even the diaspora. I remember I went even to market the infrastructure bonds to the diaspora. The second thing is that it also allowed a market for public for public debt, because even government agencies that had a healthy balance sheet could raise their own infrastructure bond. I think we can actually add that as an instrument, because we can even have conditions about the green climate, or even the sweetening, and even what kind of allocation in terms of the benefits to the public sector. So we have an array of policy measures that we can adopt. Thank you.
Thanks so much. A great contribution. If I can, and we only have 10 minutes left, what I want to say to everybody, this is a beginning of, or from the IDSC perspective, beginning of a conversation. There's so many aspects that we're discussing right now. We'll continue to with more in-depth conversations in January to see how we can contribute to this agenda. I think that the message is quite clear from you guys. Like, there's no, we have to grow with depth. I think that was the title of one of your publications. We need to look at those issues of coordination with new actors, also new private sector actors, as Stephanie is highlighting. Perhaps the last couple of minutes, and Laura, correct me if I'm not summarizing your. Well, I can actually read out your question, which is around. Maybe we can take a couple of minutes to reflect on debt swaps for climate and biodiversity as an instrument in that discussion, and of course that's a very detailed technical discussion. I think there's lots of questions about the experience about debt swaps, how they can be brought to scale. But Laura, I think your specific question is around the coordination mechanisms to get this going at this point of time. For example, the IID proposal around the shared task force to bring key stakeholders together. Stephanie, perhaps. So maybe I can, maybe you can start with Palesa. Palesa, can you comment a little bit more on those different instruments and the kind of coordination mechanism that you see from your perspective?
Unmute.
Yes, you are still muted, Palesa. As we're waiting for Palesa, Stephanie, why don't you kick us off on that?
Okay. So I think sort of ideal is you get a very sort of overarching architecture led by the G20 and so on. But I think you can also proceed a little bit in a more pragmatic and perhaps bilateral way. I mean, I mentioned at the beginning the issue of scale. I think you have to be ambitious. You have to go for something which will allow you to have a significant impact both on the level of the debt and on the expansion of investment for climate mitigation and adaptation and biodiversity. And there are a few historical examples. I think perhaps the best one is Poland. Of course, Poland was just emerging from communism, and everybody, in particular the Americans, wanted to give them a prize. So Poland got debt relief of 50%, and on top of that, it got 10% of a debt reduction. But then it worked very well, and it generated an eco fund, which was, I think, very positive. And it had another positive effect, which is that then they attracted new money. So it wasn't just the debt relief, but on the debt relief, on the debt swap, you can build attraction of new money, say by multilaterals, by NGOs, and so on. So it can be very, very positive. If I can just, if there's 1 second, can I just say that I really like the focus that Gunda had on local currency debt. I think development of local capital markets, particularly in local currency, is a really central issue for developing countries that don't have it, because then you don't have to borrow so much abroad. You can borrow from your own savings, your own pension funds, your own banks. And also a point I made before, the role of national development banks, which can, for example, help develop these domestic capital markets and help, of course, also fund projects themselves.
Thank you so much. Thank you so much, Stephanie. And let me go back to each of the speakers, maybe for a last minute reflection on particularly on the issues of the main questioning and priorities moving forward with it. Stephanie just kicked us off on. Shakira, can I go to you first on that?
Thank you.
Last thoughts, you mean 1 minute.
Okay, so very quickly, I think in terms of debt management reforms, we need to understand what works and what doesn't, and what, you know, the approach now is to do a diagnostic, do a reform plan, and just keep best practices. But that hasn't, you know, and that's not how public sector reform works. So really understanding with good examples of how to improve our approach to reforms. And as Stephanie has said in the beginning, it's more than debt management, it's domestic resource mobilization, it's public investment management reforms, it's economic policy for structural transformation. The end.
Easy. but absolutely, and that's what the importance of this discussion is. Not just about that. It's about, you know, for the development agency, how can this contribute to the SDGs and Paris agreements. Palesa, would you like to go next for a last round?
Yes, thank you. Sorry about that. I had muted myself. I think the idea of the debt for climate swap is a very good one, but there should be caution for developing countries, especially LICs, in the sense that they need to know what they are swapping their debt for. They need to have clear domestic frameworks of climate objectives that they want to achieve. For example, if they want to invest that the money in sustainable infrastructure, for example, they need to have a ready pipeline of infrastructure projects that are investable, that are good to go, that have clear feasibility studies. So there needs to be a lot of preparation for these countries to accept debt for climate swaps. To help with the COVID-19 mitigation and recovery for their economies. Thank you.
Great. Thank you so much for that for that emphasis. Absolutely critical. Thank you also to people who've posted comments. Futoshi from the IMF, a recent paper on debt vulnerabilities. Thank you for that. We'll read that and we'll come back to that. Thank you, Alex, for the comment on China, which we don't have time to discuss now, but I think we'll come back to in the future. Thank you for that contribution. Ibrahim, last minute reflection. What are the priorities for us?
Yeah, thank you very much. Two priorities. First is sound debt management, as well as debt transparency. I believe these are critical to ensure that today's debt can be repaid tomorrow and that the borrowing costs are kept in check, as well as overall debt sustainability is eventually restored, and most importantly, the fiscal risks contained. The second one relates to good governance. Even with the large fiscal stimulus we've seen in more developed countries, but that might also come up in countries in Africa that are attempting to support today's activities that are on the downward trend, money must be spent accountably and wisely, notably to raise export proceeds, also raise productivity, and most especially potential output. Without addressing good governance and ensuring debt transparency and debt management, we might be in bigger problems a few years down the road. Thank you.
Thank you so much, Ibrahim. And with that, we've come to the end of this session. There's so much more to discuss. I want to highlight first of all that this is a beginning of a conversation with those partners. And thank you for everybody for the contribution, the speakers, the people commenting. We will follow up on this. This is clearly a key issue over the coming year, and we want to see how we can contribute to that, how we can contribute to all the ongoing efforts on this from the IDRC perspective. So we will come back to all of you following up on this meeting and further conversations in January. I want to thank all the speakers for the time they've given today. We know you have very busy schedules, so thank you very much for that, and thank you for the ever-changing backgrounds, Palessa. It's very nice to see. It's good to see some colors. Thank you for that. Thank you everybody who joined. I know that people are very busy. Thank you all for participating, contributing, and like I said, we'll come back to everybody on this. And if we were in a room, we would always, of course, end with a little applause of the people who made that possible. I do want to thank Emma and Holly, particularly Holly, who this is more or less her last day at IDRC. So I just want to recognize that and say thank you to my colleagues for making this possible. This always requires a lot of work, and indeed a round of applause. Everybody stay well. Thank you. Have wonderful, restful holidays. And as I said, I hope to get back to all of you and continue the conversation in the new year. Thank you.
Thank you so much, Aryan, for this and for arranging this great conversation.
Thank you.
Bye.
Bye-bye.
Bye, everyone.
Thank you so much, everyone.
Bye, everyone.